Hi, I'm Jo, and I'm a chartered financial planner, and I've been in the industry for 11 years. The reason I got into the industry is still the same reason that I'm here today, which is I think that financial well-being is really important. And what I love about my job is being able to help people realise that money can buy them happiness, and it often isn't as complicated as I think it might be. Firstly, what is the 60% tax trap? Once you start earning over £100,000 of gross annual earnings, you start losing your personal allowance. So at that rate of income, you are already paying 40% or higher rate tax. Not only are you paying that tax, but you also then start losing your personal allowance. That works out as for every £2 above £100,000 of income, you lose £1 of your personal allowance. That is where the 60% tax trap comes in, because not only are you being charged a tax rate of 40%, but you're effectively losing your personal allowance, which is effective to 20% tax. This happens between £100,000 worth of income and £125,000. So that £25,000 worth of income is being taxed at 60%. One of the easiest ways to reduce that tax burden or to reclaim some of the tax that you're paying is through personal pension contributions. This works slightly differently depending on whether you're making it directly yourself into your pension or whether it's being facilitated through your employer. So for most people that are earning that amount of money, it's probably going to be through their employer. So it's worth having a look at your payslips and seeing what level of contributions you're making, because if you have earnings over £100,000 and you make a contribution to your pension of the amount above the £100,000, you get tax relief at your highest marginal rate, which in this case will be that 40 and the loss of your personal allowance making your 20, totaling the 60% tax trap. So to try and make that as simple as possible, if you have earnings of £110,000, you are losing £5,000 of your personal allowance. So if you pay money into your personal pension equal to £10,000, it will effectively reduce your earnings as if they were £100,000, therefore stopping that £10,000 being taxed at that higher rate. InvestEngine has a really good calculator where you can input your income as well as existing contributions, and it will tell you what tax relief you're already receiving alongside what additional tax relief you may be able to claim should it be available to you.